is one I think is really interesting. So they're a digital intelligence software company used by government agencies. And essentially what they go do is they help government agencies hack into certain digital devices and track, collect, analyze data in a compliant way so it can actually be used in court and it can help them find and catch the bad guys and bring them to justice and all that kind of stuff. So
1, 2, 3, 4.
All opinions expressed by Chris, Michael, Zach, and their castmates are solely their own opinions and do not reflect the opinion of 5i Research. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
We've kind of talked about, small cap growth stocks, why US, your screening process, everything like that. So now that we kind of have the basis of what is in the portfolio, let's turn to portfolio construction. So how do you approach position sizing at, the individual level, I guess, individual stock position?
So I'll probably take a bit of a different approach than a lot of others. Than a lot of other investors tend to take. So I think a lot of times talking to investors, and they really like taking like conviction, right? Like if you've done the work on the stock, you know it really well, have your high conviction positions kind of thing. But in small caps, I find it doesn't work quite. Small and mid caps, I find it doesn't work quite in the same way. There's just risks you can't know. There's risks you don't know. And there's risks you can't really defend yourself against, kind of thing. Let's say, if you're a mid-cap company, if you have, maybe you have 2 factories, 2 plants, or whatever it is, and a tornado comes and hits one of those plants, there goes 50% of your business, kind of thing. Like you can't predict that. You can't, even if it was, everything checked all the boxes, it was the perfect company,
Right,
or whatever.
right.
You know that if you have that high conviction position in that name, it's gonna hurt because there's just the nature of these smaller types of companies is they're just less robust at the end of the day, right? So we tend to take more of an equal weight approach in the portfolio, and there's kind of 2 tiers to that. So one tier is we target like a 2.5 to a 3% range weighting for typically more volatile names, and then the less volatile names we're happy to take something in a 4% to a 5% position, and then we're happy to let those positions grow up and above that, and then but typically if you get to that 8 or 10%, if they grow to that, we'll trim it back pretty aggressively to the that first target weighting. But that that equal weight approach just kind of is our way of giving a nod to the fact that there's just some things that these companies that you will never know, no matter how much work you do on it. And there's risks that you can never defend against. So you don't want to make the portfolio too much of a bet on any single name. And, if you still have more concentration, if you're 20 to 30 names, you can, when you equal weight those, it gives you all of your portfolio names a chance to really contribute to the portfolio versus weighted tilting things towards you may be right, you may be wrong on that high conviction. Like maybe that high conviction position will outperform, but maybe that lower conviction kind of hairier name actually did better for you, right? But if it's too low of a position, it's not going to contribute in the same way. So equal weighting also kind of takes that risk of maybe on average you're picking the right names, but what if you weighted them wrong in the first place, right? What if your high conviction name wasn't the right one versus your lower one, kind of thing. So just the equal weight approach has always just resonated with us.
Yeah, no, that makes a lot of sense. And, in the small cap space, we see a lot of reversions to the mean eventually or at some point, potentially in some of these names. And so, whether maybe one name might get a short squeeze or just, a high revenue period, growth rate period, where it sees a little bit of, kind of it gets a little bit too bought up and overbought. And so, reversion to the mean does tend to happen in the small cap space. So makes a lot of sense to, start trimming at those higher levels because you just, like you said, you really don't know when things could turn, but obviously they do have that upside, like outsized upside potential that large cap names just don't have. So when you see that upside, it's important to trim it back a little bit. And also, I think we've kind of talked about this, and you kind of mentioned it a little bit here as well, but when you have a position size that's really small, let's say it's 1% or less, it's really, it's almost too small to contribute meaningfully either way. I mean, if it goes to 0, you lose 1%. So, okay, that's not too bad. But if it goes up 5x, you only really made like 4%, which is good. But, you kind of want it at even a 2% weighting would get you to a 10% gain.
Yeah.
So,
Yeah. And you can always add to that too, right? So as that, maybe a company is higher risk and you have it in your lower weighting tier or whatever that is, but as it grows, as it de-risks, as liquidity improves, whatever that is, you have time to add to it, right? It's hard to do. I mean, adding to your winners, I think is a really great like key part. It's hard to do, but it's a key part of investing. But oftentimes, a stock that has gone up, whatever it is, X% is actually a better risk reward investment after it's up than when it was prior. So you there's more justification to hold it at a higher weighting or to increase that weighting to something that's bigger than it was before.
Yeah, definitely. And on the upside, I mean, I think we've kind of talked about it, but there's no right or wrong for the number, but I think we've talked about, 7 to 8 or 9% on the upside weighting. And I think kind of the general framework, at least for me, is that, if the expected annualized return of a portfolio might be 7% over the long run. So if you have a 7% position at your highest weighting, and that for whatever reason, the total downside, max downside is about, that thing going to 0. So you lose 7%. That's the equivalent of just losing 1 year of potential returns. So for me, it's kind of, you're set back one year at most, which, anyone can come back from a 1 year loss. But if you're higher than 7% and you're at 10, 20, 30, that's multiple years setback. So
yeah. Hopefully you don't have too many zeros.
Yeah.
Yeah, where you trimmed it before it happened or something. So.
That's fair. Yes. Yeah. 100% losses are quite rare. But certainly that's kind of the maximum pessimistic approach, I guess, to looking at stocks. Yeah. Okay, so we kind of talked about like individual position sizing. How about at the sector level? Do you have any targets for your sector weightings?
So we tend to let the individual stocks drive the sector weights more than anything. I mean, typically being more growth focused, we're going to tilt more towards growthier sectors. So that's consumer discretionary, industrials, technology, healthcare, depending on where you're in the healthcare space, but healthcare as well. So definitely going to be kind of more of an overweight type of stance in those types of sectors. But it's largely what the individual stock opportunities that we're seeing kind of build up to that often. But we don't have a hard stop on it, but generally like our comfort zone is 30% weighting in any single sector. Up and above that, we kind of try to maybe look in other areas. But if there's just a lot of opportunity or something really good is happening in a certain sector, like we're okay to let it go a bit above that 30% weight. But then we'll kind of look for other ways to sort of hedge that exposure, offset it a little bit through different strategies, I guess. So.
Yeah, definitely. That makes sense. And there's certainly, I found that there's a lot of sectors that are, they have consistent, stable, kind of really solid revenue growth, earnings growth over the years. And there's others that are more cyclical. And so kind of having that balance, for example, the energy sector is highly cyclical. In boom years, we see that go up massively. And also in the down years, it's one of the biggest losing sectors often. But other areas like, we see staples is a bit of especially in the large cap space is a little bit stable, but we see industrials be pretty solid in the small cap space. Those tend to have pretty sticky and recurring revenues. And then alongside the healthcare space as well, that's also quite recurring. So there's often different, sector kind of characteristics and things that you guys are probably looking at. But you're also probably just looking at, kind of where the market is, what the current environment looks like, and what sector is going to be most favorable. So it's probably many different ways of looking at it.
Yeah, yeah, it's kind of it's a bottom up approach, and then but you also sort of have overlays of what's the call the macro environment looking like, and even and then drilling down in different sectors. What's the opportunity set in across different sectors? Because is sometimes like in the last year, it feels like the AI investment cycle has really been driving a lot of
Yeah.
the market growth right now. So if you don't have any exposure to that, maybe you're kind of lagging or whatever it is. But still, the at the end, the company level is kind of what really drives where we position things.
Okay. Yeah, definitely nice. Okay, so then kind of switching a little bit more to broader market overview, just looking at the general markets. Can you kind of give us a little bit of your outlook on the markets? How do you feel about the markets here?
Yeah, it's um, I'd say in general, it feels a lot like I'm going to talk more kind of US markets I think right now, but
Yeah.
um, it seems like the economy is and markets in general just going back to kind of a pre-COVID world, right? It's
Yeah. Okay.
maybe not necessarily as smooth as everyone wanted it to be or as quick as everybody wanted it to be, but it feels a lot like we're just normalizing back to a slow growth but growing economy, a lower interest rate environment. I don't think we're going to go back to zero interest rates by any means, but it kind of a lot of the signs are pointing to a market where you got some growth. It's not great growth, but things are growing. Jobs look pretty good, and at the company level, company management outlook is generally positive. Nobody's waving red flags, or I'd probably argue people aren't. Most companies, most spaces aren't waving yellow flags even at this point. The consumer continues to remain pretty strong and keeps surprising in terms of kind of the macro data points. The consumer strength keeps surprising markets as well. So it's a market. It's hard to find a whole lot to be. It's not perfect. Never. There's always something to pick on, kind of thing. But I think there's a lot to be content with in the
Mm.
markets right now. I think short term you have don't want to really get into the election stuff too much, but you have maybe some short term volatility coming up with the
Yeah.
election in a month or so, 40 days,
Definitely.
whatever it is. But as everybody knows, as everybody's seeing in the stats, the election doesn't really matter. It's markets kind of keep on plodding along regardless of who's in power, kind of thing. So it's a probably long term non-issue. Short term, maybe some volatility, but it's probably also creates
Mhm.
some opportunities for investors as well.
Yeah, yeah, no, definitely. Yeah. And it's an interesting point about going back to kind of pre 2020 basically economy. It makes a lot of sense. I think, I agree. I think that and you didn't really touch on this, but kind of implied, but I think inflation does kind of hit to that 2% level and below, especially in the US. So we get to a point where, you know, I don't personally see inflation reaccelerating, so I think it will stay subdued, and I think it will be a matter of, okay, how can we kind of keep this inflation afloat at that 2% level? And I think with lowering rates, we're likely to see something with the Fed meeting tomorrow. By the time this podcast release, we'll know what the number of bips cut is, but I think with the lowering of rates, we're just going to see economic growth kind of stay buoyed here. So I think I definitely agree with all of that. And then yeah, once we get past election uncertainty, the markets really hate uncertainty. So I think once we get past that,
Yeah,
I think
for
we'll
sure you
see
have. I
something.
mean, I didn't even mention you definitely have that interest rate tailwind that should help
Yeah,
for the next 6 months or so. I mean, how quickly markets price that in is up for
yeah,
debate, I
yeah,
guess. But it's
yeah,
probably lowering the steady decline in rates is probably not going to hurt things a whole lot either. So,
yeah,
and with middling GDP growth, you're right. It's hard to paint this reinflation or outsized inflation type of story. I think
mhm,
on the U.S. side of things. So,
yeah,
and on top of that, you also have it gets overlooked on the U.S. side of things. You have a lot of really big spending programs going on right now too, with the Inflation Reduction Act and the CHIPS Act, and it's all going into industrial companies, right? Which tend to have just a higher multiplier in terms of the economy, in terms of jobs and spending and all that kind of thing, which is helpful.
Mhm,
And
mhm.
then honestly, heading into year end, with the, at some point the consumer is going to kind of tap out, but so far they're looking okay. And heading into year end, heading into the holiday season, I think you maybe have that another kind of potential catalyst to get markets really, or when people start to realize that, hey, consumers actually doing okay, and they're going out and they're buying stuff for the holidays, and it's kind of giving another little positive jolt to the economy again. So,
Yeah, yeah, no, definitely. I totally agree with all of that. And, you know, I was also just thinking it's kind of interesting, and we've talked about this a little bit as well, but since the US hasn't cut interest rates yet, but Canada has, from the US perspective, we can almost look into the future a little bit and kind of look at what has happened with the Canadian markets. And we can see that as soon as Canada started cutting, market breadth really improved. We saw REITs improve. We saw all of these interest rate sensitive areas, utilities kind of bounce back. And that really helped the TSX. And we've seen it kind of hit all-time highs in the last few weeks. So it's almost like we can kind of draw conclusions to the US market from that kind of parallel of what's happened in the Canadian markets and say, you know, once the US starts cutting, we can, potentially start seeing some of these, subdued sectors like utilities and REITs in the US start to outperform. And that will really help both market breadth and just the overall S&P 500 and likely, almost, likely the Russell 2000 as well. I don't want to use any sort of certain language, but yeah,
it'll be interesting to see how it'll be good test of how efficient markets are, right? Everybody kind of
yeah,
sees these rate cuts coming and everything, so it'll be interesting to see if markets have fully priced it in or not. And
yeah.
I'm leaning more towards. I don't think it has. I think markets need to
Mhm.
see the cut happen before they get excited. But it doesn't even matter. It matters a little bit, I guess. But um, we're not owning or looking at companies for the sake of a macro interest rate cut or anything like that. The companies that we look at have been fine with interest rates where they are. They're going to be
Yeah,
fine
right.
going lower. It's not over time. It's not going to matter. Probably won't hurt, but it's not a call it a thesis breaker for how we look at things.
Yeah, yeah, no, that's totally fair. Um, yeah, and so kind of, we've talked about the markets here, kind of going at that top down kind of approach. Are there any sectors that are particularly interesting to you right now? Yeah,
Yeah, the tech sector is always going to be a space that's interesting to
yeah,
us. It's just an area we love to look through. They're higher margin companies, typically higher growth, really sticky revenues often. It's just particularly in the U.S. There's just a lot of interesting tech names out there that you can kind of take a look at.
mhm,
On top of that, though, the kind of related to what we're saying with all the infrastructure programs and all that kind of thing. The industrial sector is pretty interesting right now as well. So they've had a nice run over the last year or two, but I do think there's kind of a lot of spending left in that sector, and these companies a lot of them have seen growth, and some of them have seen increasing margins on that growth as well, just because the supply demand dynamics as companies need the products that the industrial companies are selling, and they're willing to pay a bit
mhm,
more for them even to get them to get them delivered at the end of the day. So I think that's an interesting setup. And then also discretionary is interesting. I think they've kind of been beat up a bit more lately on fears of
yeah,
kind of the weakening consumer, particularly the lower end consumer. But again, we're kind of seeing some data points come out showing that maybe the consumer's not actually not that weak heading into that holiday selling season as well, which could be a make or break type of thing. If the holiday selling doesn't work out quite as well as maybe people were hoping, then that's going to hurt
mhm,
them. But a lot of kind of bad news is priced in on the consumer discretionary names also. So you kind of have some
right,
interesting
right,
growth opportunities at some pretty attractive valuations as well. So I think that could be a
yeah.
place to look.
Definitely. No, it's really interesting. I definitely agree with the, upside surprise potential that we could see with this consumer discretionary names. A lot has been priced in. as far as, recessionary concerns or slowdown. But, with rate cuts along the way, if we see any sort of increased buying power from consumers, this could really lift some of these beaten down consumer discretionary names. So yeah, totally agree with that. And then I'm going to get to the question that I'm sure all listeners and viewers have been waiting for. So are you able to share 2 names that you like right now?
Yeah, for sure, of course. So disclosure and all that. We obviously own these, at least at the time of recording this.
Mhm.
We own these positions, and by the time this gets posted and all that kind of thing, may have traded, and no plan to trade in them. But obviously, positions and theses can change over time. But currently, these are in the portfolio, and these are names that we like. So Cellebrite, the ticker is CLBT, is one I think is really interesting. So they're a digital intelligence software company used by government agencies. And essentially what they go do is they help government agencies hack into certain digital devices and track, collect, analyze data in a compliant way, so it can actually be used in court, and it can help them find and catch the bad guys and bring them to justice and all that kind of stuff. So interesting name. One of the only companies that can unlock the newest versions of iPhones, and with crime kind of increasingly, at least moving online, or digital components of crime becoming more and more integrated to whatever the bad guys are doing. Cellebrite's kind of on we think a leading edge of what agencies need to kind of really start improving in terms of their capabilities, I guess. So it's a name. They're growing in the mid-teens to 20% top line consistently. They have 85% gross margins, no debt on the balance sheet. They're probably pretty early in the growth runway. Right now, a lot of their success is just upselling into the current agencies that they sell to. So, new product services, or just selling more of their current services. But there's certainly kind of an international growth opportunity, we think, with a company like this as well. It first probably came on my radar because we're based out of Waterloo, and a company that used to be publicly traded in Canada called Magnet Forensics would have been one of their main competitors. That company's since gone private and merged with another company called Grayshift, and through a private equity company. So essentially, it's kind of a 2-horse race in this space as well. So really big market, lots of growth, not a whole lot of competition. There's plenty of space probably for both those companies, and probably new competition as well. And also another company we really like called Axon owns a piece of this company as well. So they were kind of a bit of a dog when they first came out, because they were a SPAC, and obviously everybody hated SPACs, and most SPACs were not great companies at the end of the day. But there were a couple that were actually pretty high quality, and we think Cellebrite was one of those. And it was, a pretty classic software, higher growth type of company. It was trading at like 30 times forward earnings when we were first, roughly 30 times forward earnings when we were first adding it. So, it's grown since then. The valuation's expanded a bit, but it's a pretty interesting opportunity. We think it's can become much of a larger company than what it is today.
Nice. Interesting. That's awesome. Thanks for sharing that.
You asked for 2, didn't you?
Yeah. Sorry, I did. I was going to follow up on that, but yeah. I wasn't quite sure if you prepared one, but yeah.
Right? Yeah. So the other one would be Aspen Aerogels, ticker's ASPN. This company does thermal barriers for electric vehicles. So essentially, like, one of the big issues with EVs is an issue called thermal runaway. So the battery gets hot, and then because it gets hot, it gets inefficient, and then the battery works harder because it's working inefficiently, and then you get that thermal runaway, and it eventually just catches fire or explodes or whatever. It's not great outcome, obviously. So these thermal barriers that Aspen Aerogels creates seem to be just a better mousetrap. So the barrier itself, it seems to be more effective, but it's also lighter, which we think is kind of more of the key, because obviously weight is important for EVs, because you want to maximize mileage and efficiency and all that kind of stuff. So if you can get a lighter product for a similar price, then why not, kind of thing. So that's kind of the bread and butter that Aspen does. But they're signing a bunch of new OEM partners. GM is their anchor anchor partner currently, and they're just starting to ramp up their production, which Aspen's benefiting from. So you kind of have these. It was riskier earlier on, but they signed the OEMs. The OEMs are starting to kind of actually pay them money for their products now, and they're signing new companies, so they're kind of proven, getting more customers, all that kind of thing. And now they're looking at getting like a loan from the Department of Energy, I believe. That'll be kind of a lower cost loan that'll help them expand their production capacity. So they're looking to build a new factory at some point that, in theory, should more than double their capacity. So there's kind of this. It'll take time and it'll cost money, but there's this nice long-term runway for this company, and then they can also just grow alongside their car manufacturer partners as they ramp up EV output as well. So there is some kind of hair on this one to some degree. A lot of concern over the outlook for EVs. Do people actually want them? A lot of their partners, it seems that they're still have plans to make them, kind of thing. We don't think that's more of the concern over electric vehicles going away is more of a story versus anything that's real. But certainly, in a different types of economy, the demand for electric vehicles will ebb and flow. But there's still plenty of market share for Aspen to take with their current partners over time. And they do kind of, because of the EV thing, they get caught a little bit in this political election stuff that's coming up. So you kind of have these weird gyrations in the stock right now, but we think longer term a lot of it's noise. So pretty interesting. I was going to say industrial company. It's technically it's a materials company, but pretty interesting name regardless. That's growing at a really nice clip right now, with a pretty long runway to grow if they can continue to execute.
Nice. Interesting. Yeah, those are two really good names. And, both are, fairly tech forward without being so involved in just, not like AI pure plays or anything like that, but, having some sort of a tech component and some sort of, high growth runway, definitely. So, no, those are really interesting names. And I'm sure listeners are going to appreciate kind of those two little nuggets there. So glad to hear that. And yeah, those have also been, performing really well over the past year. And so if we continue to see, small caps run, I'm sure that, we could probably see some multiple expansion or just continued growth in their top and bottom lines. So
Won't complain about that.
yeah, that's right. Okay, awesome. And then kind of moving into just general investor psychology for any investor, individual, DIY. So what's a common mistake that you see investors make? And how do you think investors can work to correct these?
Interesting. Common mistake. Probably there's probably two common mistakes I often see from investors, and it would be, one is just selling your winners too early. Oftentimes we'll see an investor sell. They'll be up 50% on a stock, 25%, whatever the number is, but which is great return. But then they'll just go and self-name. They'll trigger taxes, and they won't benefit from the further potential gains of that name. They're happy for that quick win and they run away. But the problem is, you've done the work. You've done the work. You own it for a reason. You found a great company that, in the case that I'm talking about, that has potential to continue growing over the long term, right? So just, you found the winner, hold on to it, let it run. Don't shoot yourself in the foot after being right and doing all that hard work, right? Because then when you sell it, you take your gain, you pay some taxes, and now you got to go find something else. And it's hard. I mean, it's not easy to find great companies all the time. And so you're setting yourself up for another triggering event of something good, potentially, maybe something better happens, but something bad to happen as well. So, and in some cases, maybe the name that went up 25, 50%, whatever it is, should be sold. It's not that it's to not necessarily never sell approach, but oftentimes the opportunity cost of selling really strong companies, the long-term opportunity cost can be so big. So just holding on to those great names and don't sell them too early. So it's not easy to do. You need to be take portfolio principles into consideration here. You can't let a single name become too much of a portfolio. You have to trim it back. You have to rebalance all that kind of stuff. Maybe if it's
Mhm.
small, you can even add to it. Who knows? But just because it's too big and maybe you need to bring the position sizing down a bit doesn't mean you just need to sell the whole thing, right?
Yeah. Yeah.
And the probably the biggest problem is that you don't, or maybe it's a good thing if you've sold it, but you don't see the opportunity cost, right? So you sell it and then you kind of just forget about it, and you don't see what that cost is versus maybe a laggard in your portfolio that you've kept holding on to, and you look at it and you're maybe it'll come back kind of thing. So I think it's just like for whatever reason psychologically you don't get punished maybe as much as you should by selling your winners early because you don't see what that cost was of selling that name too early in terms of like lost opportunity, lost gains.
Yeah, yeah, no, for sure. It's a really tough kind of thing to master, and there's so many problems with selling the entire position too soon. Because like you were saying, one is reinvestment risk. You don't know what you're buying into and how the performance of that stock will be into the future, and it could be much worse. The second is, yeah, you're right. Like some investors will sell and it'll be solely on like valuation or something too. And it's like just selling for like the wrong reason and selling entirely out of that position just on valuation. Because it's gone up and maybe the multiples expanded and it's up 25-50%. But, if it's a great company and it's up for a reason, it could very likely grow into its multiple. So,
Well, and that's interesting. It's almost the bar is lower to sell to for the for wrong,
right,
right?
right,
So
right.
the stock goes up and some mild piece of news that's maybe slightly negative comes out and you kind of look at it, it's like, well, I don't want to lose these gains. So
Yeah.
let's just sell it, lock it in kind of thing because there's this random piece of bad news. Meanwhile, in the stock that's down 20% or whatever, the bad news keeps coming. And you're just like, it's down already. Just gonna hold on to it, and it might maybe it'll come back or something, right? But
Yeah.
it's certainly there's more not incentive, but the pressure to sell your winners is far
Yeah.
higher because it's a winner, which isn't it's just a psychological thing, but it's hard to get
That's
over
right.
that.
Right.
Which I think goes into another mistake that we see a lot of investors make. And it's just getting too focused on the small stuff, I think, and missing the forest for the trees in a lot of cases. I think maybe 10 years ago, kind of informational edge was probably a true edge, but nowadays I think there's just so much information out there and too much
Mm,
information that the skill or the edge is just being able to filter through it, right? And to block out just the hundreds of data points telling you certain things that maybe they matter at the margins and like the tiniest slivers of margins, but they don't really matter for a 6 month plus holding period kind of thing, right? So
right.
just being able
No,
to
it's so true.
ignore all of that, not ignore, just filter out all of that noise. Know the 4 to 6 key material driving factors behind your company or behind your stock. Knowing what those are and focusing on those versus the other 100 million data points out there kind of thing, I think is a can be a huge advantage. And the mistake that investors make is knowing what those drivers are, but just getting spooked by other
Yeah.
random 100 other reasons to sell. There's always some sort of reason to sell, right? There's always going to be some sort of macro fear, concern, sector concern, or whatever it is. It's never perfect, but you just kind of have to really be able to filter out and know what's important.
Yeah. Yeah. No, it's so true. I kind of, draw parallels to just zooming out at that point. When you're too zoomed in and you're seeing like a daily drop of 5 or 10%, it's probably terrifying in the moment or in the day or week. But as soon as you zoom out and look at, the monthly picture, the 1 year, 5 year, 10 year, it becomes a lot less scary and a little bit more manageable. And that's really what helps investors kind of bring some level of rationale back into their thinking. Yeah. Yeah. Zoom out and don't get FOLO, fear of losing out. That's why I'm coining that
Is
that
that the
term
new
for
one? That's
yeah. That's why I'm coining it. Yeah, yeah. If you're up and you don't want to lose those gains, you don't want to follow.
you can keep that one. I won't.
Yeah, yeah.
I won't bother using that one. So.
No, okay, yeah, it didn't stick. All right. Okay, so that's all my questions. Except I do have one trick question, but don't worry, it's not investment related. So it's kind of general lifestyle. Is there a favorite place that you say you can say you've ever traveled to? Like, what's your favorite place that you've ever traveled to?
Oh, did Italy before I had kids. That was with my wife, and that was a really fun trip. That was our pre-kid
Yeah,
journey.
yeah.
That
That's
was a
right.
good one. But honestly, we just somewhat recently did a trip to Spain, and that was
Nice. Yeah,
it was just a really like felt like a classic European city
yeah.
type of visit type of thing. Just drinking wine, going to different restaurants, seeing the sights, kind of thing. It was, and it also probably holds a special place in my heart because I think it was the first big trip we've done, like true vacation trip without kids that we've done for a long time.
Fair. Yeah.
So
Okay.
maybe it has
Yeah. Yeah.
maybe just a more of a nostalgic
Yeah.
right now.
Nostalgic. Yeah.
But
In a way.
yeah,
Yeah.
that's probably the would be my top one so far. So
Awesome. Cool. Yeah. No, I've heard Spain is amazing. That's great. Love to hear it. So is there anything that you want to share with investors before we take off here?
no, I think we're going on pretty long here. I think so.
Yeah,
I don't want
that's
to
right.
take more people's time, but thanks a
No,
lot for having me on. I appreciate it. It's been fun.
yeah, no, definitely. I think it might be it might have to be a two-parter here, so we'll see. But no, again, thanks so much for joining us. I'm sure listeners and viewers are really going to appreciate all of your insights and wisdom and some of your stock picks as well. So with that said, that's all that we have for today. We hope that you enjoyed this episode of our podcast and learned something new about the Canadian and US markets. If you want access to more exclusive content and insights, don't forget to visit our website at 5iresearch.ca and sign up for a free trial if you haven't already. You can find the link in the show notes below. And if you like this episode, please give us a thumbs up and subscribe to our channel for more updates. Thank you for listening, and we'll see you next time.